My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make you a little money. My job is not just to entertain, but to put into perspective things like today. So call me, 1-800-743-CNBC. Tweet me at Jim Cramer. When it's loved in this market, it's really loved. But when it's hated, I mean, just forget about it. That's been the dynamic ever since the election. So on a not-so-hot session where the Dow dipped 207 points, S&P declined 0.6%, and the Nasdaq shed 0.64%, I want to take advantage of this breather to figure out which sectors are getting too much love and which ones are getting too much hate. Yep, we're going full Night of the Hunter. Those love and hate knuckle tattoos. If you don't know what I'm talking about, please go watch it on Amazon Prime. Let's start with love. This market, once again, enamored with those enterprise software stocks that are so expensive. Salesforce, ServiceNow, Workday, Datadog, Atlassian. Now, these have all had parabolic moves, up double digits this month, even after they all pulled back a little bit today. If you're selling software to big business, you can do no wrong in this market. But, man, speaking as a big believer in Salesforce, we own it for the Travel Trust forever, I think the stock's been on an unsustainable tear. I think it needs a breather. The darn thing's gone from 243 to 331 in a little more than 2 months. Again, I adore Salesforce. I just wish the stock would digest its gains here because the kind of straight-up rally makes me nervous. I like stair-step. Today was a good start, though. Now, same with ServiceNow, a very good company that uses artificial intelligence to help improve the enterprise workflow, among many other things. ServiceNow now sells for just under 75 times earnings. I had to take it out of the Travel Trust bullpen today at our CNBC Investing Club monthly meeting, which you can watch on a replay if you so desire. Darn thing just went too parabolic for me again. I think Atlassian Sybil Team, which makes worker collaboration software, kicked off this whole move at the beginning of the month when it reported a fantastic quarter. But now it sells for 77 times earnings. It's giving me vertigo. Now, enterprise software does tend to not have much Chinese exposure, which is a positive heading into Trump's second term. How much is that worth? Not clear. At the CNBC Investing Club meeting, Jeff Marks and I talked about which companies could be helped or hurt by Trump 2.0. Enterprise software, it came out unscathed. I think that should put a premium on enterprise software stocks. But at this point, enough is enough. I say let them come down, and then you can buy. Second group that's getting maybe too much love. This market is nuts for subscription products. I like these stocks, too, but take a look at Costco, Netflix, Spotify, and Amazon. They all have huge recurring revenue streams, and membership dues and their stocks are huge winners. All these are benefiting from endless positive research calls. They just appear each morning as if by magic. Netflix has the most fanboys. An analyst will come out and raise his price target based on the new ad model, which is going so well. Then the stock goes higher. And then another analyst will come out the next day and raise her price target for the same reason. It just won't stop. Always on the same piece of information. That is not cricket. Spotify's insane. It's been up all year, but it just gained nearly 60 points after reporting a quarter Tuesday night that actually failed to meet their earnings estimates. Doesn't matter, as Spotify is a subscription company, and subscriptions were indeed strong. So we get a Jack and the Beanstalk-like situation where it just goes up and up and up, all very odd. And yes, too much love. Doghouse. But wait a second. Today, Disney got a boost after it reported a good quarter with some profitable growth in its streaming properties. No wonder its stock soared more than $6 or 6.2%. They can't resist positive subscription data of any sort. Well, then there are the banks. Now, we've had a bull market in banks for most of the year, but they really caught fire after Trump won the election. I think this move actually justified because bank regulators won't be as tough and unforgiving as the Biden bunch and will have many more mergers blessed by a new crop of antitrust seers. Now, we heard today that the Federal Trade Commission's preparing to launch an investigation into anti-competitive practice at Microsoft. Are you kidding me? Linda Khan's term as FTC chair ended in September. She'll lose her job at the moment the White House names a replacement. And once Trump takes office, we're going to have a very different kind of FTC. I feel bad for all the trees that will have to be chopped down to make those Microsoft briefs. They could have helped fight global warming, which, by the way, is a much more important issue. With the changing of the guard at these agencies and among the bank examiners, the financials are simply worth more under Trump than they were under Biden. No kidding. Yet even after this monster move, you know what? Their stocks are still cheap. Wells Fargo stock, take that. It's up 48%, but trades at less than 14 times earnings. Average S&P stock sells for 23 times earnings, and they're not as good as Wells. Even if you think the S&P is dramatically overvalued, which I know some of you do, Wells Fargo stock is still absurdly cheap. JP Morgan's had a similar move, and it boasts a similarly low price earnings multiple, even though it could have explosive earnings growth next year if the regulators just ease up, resulting in more IPOs and more mergers. And I think that's going to happen. Finally, there are the boutique restaurants with regional to national growth stories like Cava and Sweet Green. Oh, they can do no wrong in this environment. Right behind them are Dutch Bros and Shake Shack. And why not throw in Brinker and Texas Roadhouse? These stocks keep roaring, even as they've already gone from undervalued to fully valued. I can't recommend them here on a pullback, even though I'd like them all the way. Right now, the drug stocks, though, they are despised beyond all belief. Just drop dead despised. There seems to be no place where they're safe. They are hated. We're hearing that Robert F. Kennedy Jr., big vaccine denier, will get appointed as the Secretary of Health and Human Services, which is definitely bad for Big Pharma. Maybe that's why they've been going down so hard. But these stocks have already been hit. I think that the hatred is almost priced in, except for the stocks of companies that sadly make vaccines. Robert F. Kennedy Jr. has not been a big fan of the vaccines, to say it mildly. Merck, with a great stable of cancer drugs, now sells for just over 10 times next year's earnings. Pfizer, which picked up some potentially revolutionary cancer therapies from Seagen, is now trading at 9 times earnings, 6.5% yield for heaven's sake, although it has a vaccine business and it calls vaccines, and I quote, one of the greatest public health advancements of all time. Uh-oh. Still, anything good there, it could fly. But these stocks are trading like Bernie Sanders just won the election on a platform of socialized medicine. These stocks are just way too hated. Sell. But nothing is as hated as much as the semiconductors. Skyworks, Micron, Qorvo, all eviscerated. Same with NXP Semi, ON Semi. It's been horrendous. Even AMD has been very heavy. Only Intel and NVIDIA are still running. Intel because it had already come down so much. NVIDIA because there's an insane level of demand for its high-end chips. I think the hatred comes from a sense that these new AI-powered PCs haven't taken off and the cell phone business is still weak. Now, the group tried to bottom today. About a month ago, an outfit called ASML, it's a semiconductor capital equipment maker, told people the future looked bleak and lowered its forecast. You know what that did? That put every one of these stocks through the meat grinder, dragged down the whole group. But today at a management meeting, ASML was actually a tad upbeat and didn't lower its forecast. Stock ran up nearly 20 points. That was the good news. But after the bell, Applied Materials gave us a downbeat forecast, same business, and it's plummeting in aftermarket trading. Hi, haters. Here's the bottom line. We have a lot of overly loved stocks in this market right now, but many of them deserve the love, just not at these levels. As for the group that seems to be down into a bottomless pit, call me interested, but only if we get a couple of days where they stop sinking and we have more clarity from President-elect Trump, who is going to take many stocks to the woodshed. We need to see the floor of the abyss, unless, of course, we're bouncing off it already. And for the overly loved, don't look for Trump for support. He can surprise you with what concerns him. Do not get too cocky. Do not get too smug. It will hurt you for certain. Let's go to Richard in California. Richard!
Hey, Jim, how are you?
I am good, Richard. How are you?
I'm calling today. Good, thank you. I'm calling today about a game-changer deal this company just announced with GE Health. This company developed its own AI and is being built into every GE new mammogram machine. GE said they just reinvented the mammogram machine with this AI. Sales will start this December 1st. Jim, as an investor, I'm really excited about this. Is there any way to try to get the CEO of RadNet on your show?
Well, first of all, I'm not excited about it. I know RadNet. I understand the deal. What I'm excited about and exasperated by is the fact that they allowed GE to sell, the parent, sell a ton of stock at 13 million shares at 88. The stock's now at 82. I don't like that, and I don't think that deal moves the needle. I am sorry. I don't know for my trust. Sorry if I'm steamed. But once again, I find myself behind the 8 ball with a company that I think is my friend, but I'm not sure. Bob in Florida. Bob.
Jim, this is Bob from Florida, a founding member of the club.
Thank you. I hope you liked the club meeting today.
An excellent meeting.
Good. I'm sorry?
No, in the financial
sector.
sector.
Thank you. Thank you.
Okay. In the financial sector, my portfolio has Goldman Sachs, Wells Fargo, and BlackRock. Would it be a good idea to add Banco Santander to the list?
I have been thinking and thinking and thinking about this. When you watch the show, you know I'm doing that. I think it's an excellent, excellent idea, and I applaud you. Well, thank you for listening to the call. I applaud you for thinking very, very much like where I'm going when it comes to that great Spanish bank. Let's go to Prasad in Washington. Prasad.
Booyah, Jim. It's Prasad from Monroe, Washington. Wanted to hear your thoughts on Intel Corporation. I've been buying the stock since mid-20s. Between Intel's foundry business and any potential AI play,
Okay, I felt that when the stock dropped 55% that it was time to stop putting the hate on Intel. When it fell from 50, where I told people to sell it, and I say sell it. I didn't say hold it. I said sell it. When it got to 23, I said enough is enough. I can't think of a reason why it can still go up from here, but I'm done thinking it's going to go down, at least until something bad happens again, but I don't think it will. Let's go to Kyle in New Jersey. Kyle.
My best friend, Jim Cramer. How are you, buddy?
I am doing good, partner. How about you?
What's the world record for call-ins on the show? Because I want to beat it.
What's the world record? I don't know the answer. I'm looking at Regina Gilligan.
Whatever it is, I'm going to beat it.
I want you to beat it. I think that'd be fantastic.
But listen, my girlfriend and my future mother-in-law are on their way up to the Eagles game right now. So
I wish I could. I've got some sort of engagement. I wish I could be there because I've got my box and it's empty. Go ahead.
But I might have to have them scalp their tickets because Cleveland Cliffs beat my teeth in today. So what do you think? Am I holding, buying more?
Okay, I think you can hold Cliffs. You have to understand that the price of steel continues to go down. We spoke to speaking to the CEO of CSX. It's still weak, and so therefore numbers may not be able to go up, and that is they won't turn until the numbers go higher. All right, look, the overly loved stocks are just, you got to give them a breather. How about that? And the overly hated stocks, I think they may be too low. I say temper your emotions. Don't get too cocky when it comes to predicting anything right now, though, when it comes to the president-elect Trump. On Mad Money tonight, shares of SoFi are on the run again. But can the climb continue in this rate environment? I've got the CEO to talk about earnings and a new partnership. Then insurance company Unum soared to a new all-time high today. I'm looking closer at what's driving this growth with the company's top brass. And as I just mentioned, is rail stock CSX on the right track for the long term? I think it's very interesting. So let's check in with the CEO, fresh off its recent investor day. So stay with Cramer. In the last few months, Sofi Technologies has finally gotten its groove back, and notice it's technologies. This digital bank was one of the hottest stocks around through the pandemic. Then when the Fed started tightening in 2022, its shares were obliterated. In fact, it was still trading in mid-single digits in August. I defended it all the way down because of my faith in the CEO and his business model. And lately, my fellow SoFi believers have been rewarded as the stocks climbed from $6 in early August to $13 and change today, its highest level since early 2022. Now, some of that's thanks to the Fed rate cuts, which should help stimulate SoFi's lending business. Some of it comes down to earnings. SoFi reported a clean beat and raised quarter in late October. Some of it's because they've made some major partnerships, like a $2 billion deal with Fortress, I love those guys, to expand the lending platform, or team up with BlackRock, another place I love, to create a robo-advisor platform announced earlier this week. So can this thing keep running? Let's check in with Anthony Noto. He is the CEO of SoFi Technologies, longtime friend of the show. To find out, Mr. Noto, welcome back to Mad Money.
Jim, thank you for having us, and thank you for all your support.
Well, let's go over that. The reason I supported you, some of it is because I've known you forever and always think that you're one of the best I've ever met, but also because you had a vision, and the vision was to become more of a service company, but that you were never in doubt, even that people said, listen, your loans must be bad because you don't want to sell them, all that nonsense.
Well, Jim, our goal was to set out to help people achieve financial independence. In order to do that, we have to be a one-stop shop for all their financial services needs, and it takes a while for each one of those businesses to grow. But we're not a lender anymore. In the most recent quarter, we reported 49% of our revenue came from non-lending. We grew revenue overall 30% year over year, and it was driven by financial services products and our technology platform, not lending, which was up over 60% year over year.
Okay, so let's go over lending. There were people who came in and said, Jim, These loans must all be bad, and that's why he won't sell them. You stuck by them and said, look, no, we're going to do, we have the cushion, we can do what we want. So who was right, the bears or the bulls?
Ultimately, we've delivered results, 17 consecutive quarters of record, 17 of 19 quarters of record revenue. We've had 19 quarters of more than 20% year-over-year growth, and we've continued to diversify the business. At the beginning of the year, we felt we could actually grow the other businesses, not take on much risk, and show that the loans could perform, and they've performed really well. And in fact, credit has improved throughout the year.
Well, I think it's important to point out that in the last few quarters, things are just getting better and better. The loan delinquency 90-day, 0.57 down from 0.64. A charge-off, 3.52 down from 3.84. These are major when it comes to a delta, the percentage.
Absolutely. Those curves are not easy to bend, but we did it through disciplined credit underwriting standards. We tightened the standards as rates went higher. We increased WAC on the coupons to make sure we had the right risk reward on our loans, and that's why we've had such strong performance.
So talking about the Fortress deal, I think they're very exacting. They don't get involved unless they think that they're going to get their money back. They are probably the shrewdest, I think, of the big private equity companies.
This concept of a loan platform business where we get paid fees for originating loans for other people that want to buy those loans, it really started as an idea back in 2019. At first, when we declined a loan applicant, we would send them to another partner that would underwrite that loan and we get paid a fee. We've evolved that over time where now when someone applies at SoFi, we can either approve the loan on behalf of somebody else using their credit model, or we could approve the loan and get paid a fee for that loan by our third party. It allows us to monetize things we wouldn't otherwise monetize.
Okay, so talk to me. People say, well, wait, what's going on with student loans? What is it? The pause in student loans, maybe they're not. I always say to people, look, it's not like that. That's the old days, and it's a piece of the puzzle, but it's not the puzzle. Is that a correct view?
It is correct. The student loan refinancing business really got hurt during the pandemic when the student loan moratorium hit, and then rates rose over time. That business is a small piece of our business. It's actually doing quite well, especially as rates come down. People will be able to refinance their federal student loans with a lower cost loan. They also could refinance their own personal student loans at a lower price, just like they would their mortgage. So it's a complement to the business, but it's a very small piece.
Okay, so let's talk about the BlackRock deal. We know that Robo is no longer a moron. Robo is real and can be many times superior. I don't mean to denigrate the human race, but we know there's a lot of stuff that's just repetitive. What will this platform mean for you with BlackRock?
This is an important component to our overall mission. We want to help people get their money right, and we want to be a one-stop shop to do that. Within Invest, we also want to be a one-stop shop, but we want to give our members, our investors, access to asset classes they would not otherwise normally get. Asset classes like IPOs or alternative investments that are typically reserved for high net wealth individual. We're giving the Main Street investor access to IPOs, to alternative assets, which we launched at the beginning of the year. And this week we launched Robos with alternative assets. We originally had 3 Robo accounts that really primarily invested in equities, fixed income, and money market funds. And now we've introduced Robo accounts with those assets plus alternative assets with our partners and BlackRock.
Now, people must like these because I'm looking at a new member additions page of 756,000 in Q3 alone, bringing the total to 9.4 million members, plus 35% year over year. Where are you getting all these people?
Yeah, we're absolutely capturing market share from the broader universe of checking and savings accounts, from other brokerage accounts, but we're also enabling people to invest for the first time. So beginning investors and novice investors, one of the reasons we launched fractional shares was to allow someone to buy something they like Tesla or Apple or NVIDIA, for $1 at a time instead of 1 share at a time, which is typically, for those companies, $100 to $203 per share.
Well, we had a question today on our investment club, which you know about, and it was, why should I buy BlackRock? It's $1,000. This is another way to buy some BlackRock.
You could get access to BlackRock's funds. You could also get access to BlackRock stock through fractional shares or these ETFs or robo accounts.
Excellent. Now, the last time I saw you, we also had to talk about the idea that you had to issue some stock, but it wasn't dilutive. People thought it was dilutive. There were analysts who got it wrong. There were analysts who were betting against you. The stock got hit. It was part of a convert. Where is that? And do you have to do any more of that kind of issuance?
No, we're in really good shape. We were able to capture some opportunity to refinance at a point in time where it was attractive to investors and attractive to us, but we're well capitalized now, and our 3-year plan that we laid out at the beginning of the year, we're well on track to achieve that. And last quarter's results was further evidence that we'll deliver on 2025 and 2026 barring any unforeseen circumstances.
Excellent. I can't have you leave without asking you. I hate that it's Veterans Day. Okay, my dad always said, why isn't it Veterans Year? I mean, you sacrificed a lot, was a sergeant, all that. I always think of you in the Army. Congratulations so far for Army. What are you doing for veterans? Because you know veterans and their issues more than anyone.
Yeah, we are very focused on helping people from a mental standpoint and have mental health. It's an important cause that we have focused on that obviously pertains to veterans as well. We also employ veterans, and we have inside SoFi, we have a group which we call Stripes as an affinity group for veterans. Obviously, it's very near and dear to my heart, having served. But I thank all those that are out there putting their lives on the line for democracy. And we're in a very uncertain time today on 3 different fronts. We could face very challenging times. So our message goes out to them. Thank you for your service and defending our country.
Well, thank you so much for coming here and saying those things. Thank you for being, of course, a man of your word, which I of course, never doubted, as you know. But there were plenty of people who said, well, I don't know, Jim. I do know. And what we saw today and we listened to you and what we saw with these deals with BlackRock and Fortress, 2 of the best, all deserving for you. Thank you for sticking with it.
Jim, thank you. We're just getting started. Some more to come.
I think you are. It's Anthony Noto. He's Sofi Technologies CEO. We told you. Mad Money's back after the break. When the Fed started cutting short-term interest rates in September, bond traders merely took the other side of the trade. Long rates soared. Remember, the bond market is what sets longer-term rates. That's created a tricky situation for many industries, but it's fantastic for the insurance space. These companies take your premiums, they invest them in safer fixed income assets like treasuries. So higher bond yields mean they get a better return. Insurance stocks have gotten a real boost, especially since the election. Bond traders are betting that we'll see a lot more government borrowing once Trump cuts taxes. So can the insurers keep running? Consider the case of Unum Group, which is a major provider of workplace benefits. Think disability, life, accident, critical illness, dental, and vision insurance. This stock's up a cool 60% year to date, with about half that gain coming since the end of September. Could have more upside. Let's dig deeper with Rick McKinney. He's the president and CEO of Unum Group to learn more about what's going on here. Mr. McKinney, welcome to Mad Money.
Thanks, Jim. It's good to be with you and your
I'm so glad you're here. This has been Unum's been one of the hottest stocks around. And yet, if you look at it, it's still incredibly cheap versus both the banks and the S&P 500. Can you tell us the story of Unum, why it is so inexpensive and why that's undeserving?
Let me talk a little bit about the company and what we do. And so you mentioned the products we're in, but most importantly, we're there to protect people at time of need. We're in the workplace, and so we actually have the scale across the country. 45 million customers, 175,000 employers that we're taking care of. So the underpinnings of the company are really good. You talked about the dynamics of when we bring in those premiums, which we're actually growing over time, investing them and paying them back in benefits. That's what we do.
You don't own a huge portfolio of commercial buildings.
No, we actually have I would consider a pretty vanilla portfolio. Yeah. Corporate credit's what we're invested in for the most part. And so when you think about that, we're in the business of making sure that we're going to be there to make those benefit payments coming off the premium. So we don't want to invest in anything that's too esoteric.
Now, I think that one of the things that held you back, and a long time ago, I met with Unum Management, and my late father had this long-term care, and he had paid very little for it. Next, he was having a live-in. It cost a fortune. He was always so grateful that he took it, but that was a bad policy to write. You used to have some exposure to that, but you've pretty much ring-fenced it. It can't keep your stock down anymore.
I think that's right, Jim. So these are policies that were written back in the 90s, early 2000s. And so over time, we've worked through that. We stopped writing individual contracts in 2009, didn't add any more groups after 2011. And so we've been able to work through that business. And last year, importantly, we put a lot of capital behind it to say we're not going to put more capital behind this business because we think there's an ample amount there today. So that is a reality, and it is a little bit different than it was if we went back 10 years ago.
Well, my thinking is if you've got it ring-fenced, maybe there'll be a buyer, some private equity guy who realizes, you know what, this thing is, I want to take this risk. They've already pretty much articulated it, which would be fantastic for you.
Yeah, so actually a year ago, there was a transaction done in our space. We didn't do it, but actually another party did it, which saw those dynamics that you're talking about. And it's something that we would like to do because, relative to the rest of our business, we take care of people during their working lifetime. Long-term care is a very different situation. So it's not strategic for us. We'd like to transfer that to somebody else.
What do you think is the reason for the stocks to have such a big rally after President-elect Trump won the election?
Well, I think when you look at us and what we're trying to do is overall benefits are really important to our individuals. And we think about it as financial security. So the people at the workplace, the financial security they have, and that's something that's got a bipartisan appeal to it. So in terms of the increases we've had today, I think there's a lot of dynamics about growth that we have. What we do is certainly very important. And then you also talked about the dynamic of a little bit higher interest rates helps as well. So all those come together, and I think we've seen some benefit from that.
Do you have any exposure to tort lawyers suing?
We don't actually. We actually, certainly our policies, people will actually look at them, but we feel very good about the quality we have. Our business is about, our purpose is about taking care of people at time of need.
Right.
We want to make sure that we're doing that. So we work very hard to get people back to work. Last year, 300,000 people we were able to help get back to work. And so quality is really important to us.
Now, when you say help to get back to work, that meant that you tided them over? How do we put that? What does that mean?
Yeah, so for long-term disability, importantly, when somebody becomes disabled, and if you think about the top two causes of that, it would be musculoskeletal, and number two is cancer. When somebody has that event, they're not thinking about going out on a disability claim. They're thinking, how do I get back to work? How do I get back to my lifestyle? What we want to do is play a role in helping them do that. And our benefit counselors are extremely good at giving somebody a plan to get back to work. Good for the employee, good for the employer, and ultimately good for society.
One last question. One of your principal competitors spends a fortune. We see their ads. They have a bird in it. I don't know if I really want to mention what they do, but everyone knows that it quacks like a duck, so to speak. And you quietly do your job. Why do you not want to have a name on a stadium or have a big ad campaign?
We quietly do our job, and I think when you think about our business, we're business to business. And so, it's important to us that a human resource director, that the one that's making the decision, or a CFO, knows Unum, and they certainly do, and we're considered to be the best in the business, and we want to keep that reputation. So it's important to us that we just have a brand that they know, and that they know that we're going to take care of their employees.
And I know nobody ever doubted that you weren't the best in the business. I know you had that long-term care, but no one doubted that what you do incredibly well. That's Rick McKinney, President and CEO of Unum Group, UNM. Okay, 52-week high. Let it come in a little if you want to, but this is a very inexpensive stock. Mad Money's back after the break. Right after the election, the railroad stocks soared, although they've since pulled back from their highs thanks to some hotter inflation numbers. Remember, the rails are textbook cyclicals. Normally, they're big winners when the Fed cuts rates, but if inflation ratchets back, well, traders are betting that maybe that we won't get the rate cuts. I say do not overthink that nonsense. Right now, the Fed is your friend. And that's what matters. Everything else is just details. Take CSX, the big East Coast railroad that rolled out some very bullish long-term financial targets at its investor day last week. If they can hit those numbers, this stock's going much higher. What gives the company that confidence? Well, why don't we talk with Joe Henricks? He's the president and CEO of CSX to find out. Joe, welcome back to Mad Money.
Great to be here, Jim. Thanks.
You put out some really bullish, what I thought, big stretch goals. What makes you confident you're going to hit them?
Several points. One, industrial development coming back to the United States, in our network, especially in the Southeast and Midwest. We said we can gain 1 to 2 points of revenue just from the industrial development, 500 projects on our network right now. And then in addition, the intermodal opportunity. Once truck rates come back a little bit, maybe diesel prices come back over time, we think there's 4 to 5 million opportunities on the intermodal. And then the investment we're making in our network, what we can do in places like Baltimore and other places. So we're really excited about the opportunity. And when rates come down, helps housing, autos, steel, things that we move.
Well, Joe, in the presentation, which was really fabulous, had everybody speak at the top, and I loved it, you did talk about first, industry went away. I mean, you really were very vocal about how it just disappeared, but now it's coming back, but it's a different kind of industry. Still good for you?
It is. When you think about it, over the course of decades, we were moving manufacturing away from the United States. Now we're bringing it back. And maybe we'll have more conversation about that even over the next 4 years. But if it's in the United States, we'll move it, especially if it's manufacturing production. We've grown the last 2 years in merchandise volume, but yet industrial production has been negative in the United States for 2 years. So even though this economy has grown, industrial hasn't. So if we see that come back, even more bullish for our business.
Look, if you take President-elect Trump at his word, then there'll be more reshoring, and that every time a company has to react to tariffs and maybe has to build here, there's a good chance, because your network's so vast, it may hit you.
That's right. 500 projects on our network as we speak right now. Another 1,000 sites in our inventory as possibilities. When people want to build big projects in the U.S., where do they go? Most time, Southeast, or even a little bit of the Midwest or Texas. But we're the dominant player in the Southeast, really helps us.
Now, I can't ask you to opine on the stock. That's what I do. But I'm looking at Norfolk Norfolk Southern seems a little expensive to me. Union Pacific a little expensive. You have dramatically outperformed your peers from 2016 to 2023. I'll let you have the floor to tell me how you did that.
Well, I think first of all, we rationalized the network and really cut costs to become an efficient network. Then we took our operating model and we started turning it around and saying, you know what, how do we leverage this strong operating model to serve our customers better? We're the only Class 1 railroad the last 2 years that's grown merchandise volume. That's because of our service levels. It's our people doing that. And we said, you know what, let's change the culture. Let's stop fighting for 200 years with our employees. Let's bring them as part of the equation, help them become better at serving customers, help us grow the business.
That's a lesson that I wish others would not ignore, so to speak. You have good labor relations, and you think they are important to the success of your enterprise. Why do you see it that way and so many other people want to fight the last warrior?
You know, at the most basic part, we're a service business. The best service businesses have their employees that are engaged in wanting to provide that service. They're motivated, they're part of the organization. So let's start there. We're a service business. Our employees move the goods that we get paid for, you know, and then how do we engage with them to help us provide better service to customer? People don't come in at a restaurant or a railroad and say, I want to serve people poorly today. Make them part of that solution. We serve customers better. People will come back to rail because we have all kinds of advantages.
Well, I wasn't really a topic of your day, but I think people want to know, casual people who are not the analysts, how did you solve that Baltimore terrible tragedy? How were you able to make it so that everyone told me you'd be offline for months? That wasn't the case at all.
Well, first of all, I got to give a lot of credit to the Army Corps of Engineers and everyone involved in Baltimore when the Francis Scott Key Bridge came down. They got to work quickly in 2 months or less to clear that port. For us, we went to, within 2 days, we set up an intermodal service with our employees from New York, New Jersey to Baltimore to get them containers back and forth. Within 2 days, we had people willing to transfer to help make that happen because we needed more employees away from Baltimore and other places. Again, testament to the culture, the people being part of the solution. If you ask them, engage with them, they'll help you make it happen.
Well, there you go. That's a nice lesson to learn. I hope everybody hears that. Now, what if China trade drops off? That doesn't mean trade drops off. You're an East Coast provider. Would there be more from Europe? And what will happen geographically? What are you thinking about could happen?
Well, from our standpoint, actually, as long as it's coming to the U.S., we're going to move it somewhere.
Right.
If it comes to the western ports and it needs to go to the east because 2/3 of the population are in our network, it'll come across and we'll get it in Chicago or Memphis or somewhere and we'll move it over. If it comes to the East Coast, actually, a lot of times it gets trucked from the port to a big city because it's right here. So actually, but if it's made in America, we'll move it on rail. So actually, it's bullish for us to bring more stuff here. And if tariffs change the trade portfolio, as long as the economy's growing, we'll be a part of it.
Okay, now we went over intermodal. That's doing great. Minerals and coal, still very big for you. And look, I understand coal. It's got its cons and there's some pros because they may not have returned. Yeah. But coal still holding. You've gotten coal down. It's no longer going to impact you negatively. It probably works in your favor now.
It's, we think the next 3 years coal volume's pretty flat.
Right.
But that's growth in export, domestic utility down. That's good for our business because we get more revenue from export coal. But metallurgical coal, that is a bullish market. Everyone we talk to, India, Eastern Europe, a lot of the growth for coal, for concrete production, steel production, whatever. So we think there's going to be a market for coal for quite some time. It's our second largest customer segment. Intermodal, chemicals, and then coal. Right. It's going to be around for a while.
But I am worried about metals. The price of metals have come down. We were doing some work after you suggested to me that perhaps I should be thinking about steel. I am actually kind of flabbergasted how steel has kind of really got crushed here. How's that possible?
It's actually it's our biggest sector that's down this year.
I know.
And, some of that's auto. Auto production isn't up as much as we expected. So that's part of it. And part of it's just the pricing. And, I talked to a lot of the steel CEOs. They say it's cyclical and the pricing's down, but we need it to come back. But hopefully, if we start building more in America, we can get more steel production.
And I think that with interest rates down, it will come back. I've been looking at all the steel sizes.
We need housing
very
and autos, both very price sensitive and also interest rate sensitive. If housing and auto can come up, steel will come up with it.
And how's ag? How are they doing?
They've been doing really well. It's a good Midwest harvest. We move a lot.
You actually follow this stuff. You got to do all that, right?
We have to do all of that. The fun thing about being in the railroad is you touch all sectors of the economy and get to see it, what's up, what's down, what's moving, what's not. It makes it pretty fun.
Okay, the last one that is very, very big is chemicals. Now, I know you guys carry a lot of chemicals that are things that I don't necessarily want a car to go off the track. How much is safety in chemicals? How much does it matter?
It matters a lot. Actually 98%, I think the number is 98% of hazmat-related chemical accidents happen in trucking, not on rail. Rail is the safest way to move hazardous materials by far, and we move a lot of them. But it's our biggest customer segment. We're proud of the way we do it. It is important for safety. I'm proud of the industry's performance there. We can always get better. But it's a big customer segment and growing this year, importantly.
That's true. It's absolutely growing this year. And there are so many chemicals that we have the feedstock that's the cheapest in the world, so we should be taking advantage of it. That is Joe Hendricks. He's the president and CEO of CSX. I can show you charts which make no sense to me. The charts of how well they're doing in business and how low their stock is, which makes no sense. And you should listen to what Joe says. Mad Money's back after the break. It is time. It's time for the lightning round. Chris, remember, that's what Bradford Card 1. He's saying the stock is selling by buy, sells, will sell. Just to be clear, another core stock question. That my step principle graph for the 5. We plan to sell. And then the lightning round is over. Are you ready? Ski Daddy. Time for the lightning round. Chris, let's start with Jerome in Florida. Jerome.
Hi, Jim. Thanks for taking my call.
Of course.
Thank you, Jim. My lovely wife, Barbara, and I watch every show.
Thank you very much. Thank you.
Also, my wonderful grandson, 16 years old, Reuben Siegel, is also an avid investor.
We love that. We love that.
We all think that Altria is undervalued.
Well, Altria is undervalued, but I can't recommend it because I'm not going to recommend tobacco stocks. I have a long history of not recommending them because I just don't think I should recommend something that is so bad for you. Let's go to Tim in Iowa. Tim.
Jim, Tim in Southeast Iowa, I want to thank you for staying on the air. I know you could do other things with your life.
You're very kind, and yes, don't tell my wife. So how can I help?
Back when Supermicro was a whole lot higher and accounting problems became apparent, you reminded us of a little sticky note on your computer that said accounting problems mean sell. Is that still the case now that it's down around 8?
Absolutely, sir. It is still the case. I don't know how they can find an order. I don't know how they're going to be able to fight the delisting. Accounting irregularities equal sell the whole way until it's cleared up. And these guys have not cleared up anything. Let's go to William in Michigan. William.
Hi, Jim. Thank you for taking my call.
Of course. Thank you.
I'm calling about Boeing. With a massive pipeline as the only U.S. commercial plane manufacturer, and with the recent secondary offering priced at $143, do you think this is a good entry point to start a position?
This thing broke down so badly. There are only 2 of them. This company's going to lose money for a long time. I prefer not to be in a stock that is going to lose a lot of money for a long time. Let's go to Jim in Texas. Jim.
Hi, Jim. Your take on Becton Dickinson, BDX?
This stock has broken down severely, and I don't want to be too involved where it is in the health food chain, because if Robert F. Kennedy Jr. is going to be the head of HHS, then it's going to hurt a lot of vaccines. It could hurt a lot of their business. Let's go to Eric in Texas. Eric.
Hi, Jim. Long time. Good to talk to you again. My daughter Rosie and I listen to you on the way to soccer and gym every day, and she's going to give you the name of a speculative biotech we want to get your opinion on.
Okay.
Rosie, go ahead.
IDYA.
IDYA. Okay, Idea Biosensors. Now, I have to tell you, your daughter's got horse sense if she likes to speculate, but they have a lot of phase 1 stuff, and phase 1 is mighty early. Too early for me to bet on. Let's go to Gary in Idaho. Gary.
Hello, Jim. Thank you for taking my call.
Quite welcome.
I have a large position in AstraZeneca. During the last 2 months, it's fallen like a rock.
Yeah, it's disturbing to me. You know, we had the CEO on, and I thought the story was really good, and I was about to add it into the bullpen, but hold from my Charitable Trust, which we talked about today at our 12 o'clock meeting. I have to tell you, I have been chagrined by how that stock is acting. I just don't know what is wrong. I know that they had some failures, but my God, is this thing going lower? And that, ladies and gentlemen, is the conclusion of the Lightning Round. Nobody believes me about Europe. It's just driving me crazy, or at least more crazy than usual. Last night, I asked the top-notch CEOs of Cisco and MasterCard, 2 massive companies, how Europe's doing. The answer from both, very strong. Yep, according to Cisco CEO Chuck Robbins, Europe's finally turned as those countries are trying to develop their own new technological infrastructure. There's been a pickup in spending pretty much across the board. It's so strong that even the telecommunications companies, which have really been in the doghouse, are finally spending. It's been ages since Cisco's seen that kind of activity in Europe. MasterCard's seeing very strong transaction levels in many parts of Europe. Italy, not a place known for its growth, has accelerated far beyond what people expected. I've been fixated on the turn in Europe, a continent of 750 million people, by the way, that seem to have been left behind by Wall Street, almost becoming a non-entity in many investors' eyes. I first heard about the turn from Anna Boutine, the incredible executive chairman of one of the largest banks in Europe, Banco Santander. She mentioned that was mentioned possibly by a viewer earlier in the show. Now, see, Boutine's already seeing strength all around the southern rim of Europe. The same countries that were collapsing more than a decade ago are now doing great. Portugal, Ireland, Italy, Greece, Spain. You know, we used to call those for their initials pigs when they were borderline bankrupt. Now they're the leaders. Pigs are flying. Then we had the European inflection at Amazon. These guys spent ages losing money in Europe, only to finally make $1 billion over there in the most recent quarter. $1 billion. I don't think it's going to stop. I think Amazon stock has been roaring in part because of a belief that Europe can make them a heck of a lot more money than $1 billion in profit. Apple also picked up an extra $1 billion in profit from Europe last quarter, something no analyst saw coming. Today, Burberry, crushed by China, is offering a positive restructuring. Deutsche Telekom had good things to say. Even ne'er-do-well semiconductor capital equipment company ASML from the Netherlands stood by its reduced forecast from a month ago when the betting line was that they would cut it big, and that's why the stock soared. Yet no one is paying attention because Wall Street gave up on Europe ages ago. Of course, the reason is obvious: Germany. Now, here's a country that's synonymous with the auto industry, and autos simply aren't selling well. Volkswagen's closing 3 plants, the first time they've had to do that in their 87-year history. Workers will see their wages cut by 10%. I'm not sure how Volkswagen's $5 billion plus commitment to the American Rivian is going down on that factory floor. But the real culprit's China, which isn't buying nearly as much as it used to from Germany because their own auto industry's finally caught up to the West and because they're not doing that well. It's not just Volkswagen. The German automakers haven't been hit this hard since the Second World War. BMW saw its sales to China plummet by 33% in the third quarter. That caused earnings to shrink by 61%. Mercedes-Benz experienced a 13% decline in Chinese sales, cut their profit in half. These are big numbers, people, and they seem to resonate much more loudly than anything positive we've heard from the manufacturers in the rest of Europe, especially the former pigs. But maybe, just maybe, people will start thinking about a turn in the entire continent if President-elect Trump really does have a way to end Russia's invasion of Ukraine. It won't offset the losses in China, but if that war ends, you have to believe Europe will see the biggest rebuilding boom in decades. I know that one day we'll look back and think we were too paralyzed by tariff talk, German woes, and a history of lethargy to remember the old days when Europe was a growth market. I just wonder how many times I have to ask CEOs, how's Europe doing? Only to get a surprise grin that says, how did you know? I like to say, there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.